What's going on YouTube? Chris here from Project Option, and in today's video we're going to be discussing put options. If you didn't catch it, I just uploaded a video describing call options in great detail, so this is sort of the follow-up to that video, but in this video I'll be describing put options instead of call options. Put options are one of the two primary option types, with call options being the other option type. So as a put option buyer, you have limited loss potential and significant return potential, and when you buy a put option, you are betting that the stock price is going to decrease, since put options increase in price as the stock price decreases. As a put option seller, you have limited profit potential, significant loss potential, but with that you have a high probability of making money, since you can make money as long as the stock price remains above a certain price as time passes. But we're going to go through examples of all of these things, so be sure to stay tuned. In this video, I'm going to explain put options to you in great detail, and I'm going to go through numerous historical trade examples so that you can see exactly how put option trades have performed in the past based on various stock price movements that were experienced over the duration of those trades. I'm also going to show you exactly what it looks like to buy and sell put options using the tastyworks brokerage software. So if you're interested in seeing what it actually looks like to use trading software to make the trades that I'm going to be teaching in this video, be sure to stay tuned. To get started and to first understand what a put option is, I'm going to be describing put options and teaching them from the perspective of a put option buyer. If you're familiar with call options, or you've seen my call option video, you'll know that a call option buyer has the right to purchase 100 shares of stock at the call option's strike price. It's the exact opposite with put options. A put option buyer has the right to sell or short 100 shares of stock at the put option strike price before the option expires. In options trading, a strike price is the price at which shares will be traded if the put option, or the option contract in general, is exercised. If a contract is exercised, that means the person who bought that contract is choosing to convert that option into shares of stock. With a put option, if a put option buyer exercises the put option, that means they are deciding to convert the put option into short shares of stock at the put option strike price. Now all that means is that if they exercise the put option, they will sell 100 shares of stock per put option at the put option's strike price. As an example, let's say we're looking at a put option on Tesla with 57 days to expiration, and the strike price of this particular put option is $350. Let's say the current market price of this option is $19.55. If a trader buys this put option with a strike price of $350 and 57 days to expiration, and they pay $19.55 for this option, this trader will have the ability to sell 100 shares of Tesla stock at $350 per share, since they purchased the $350 put option expiring in January 2020, which has 57 days to expiration. There are two basic concepts that you need to understand before we move forward. The first concept that might be confusing at first, but you need to understand, is that options are quoted on a per share basis, and all that means is that since an option can be converted into 100 shares of stock, the option's quoted price is not its actual valuation. So in this case of looking at a Tesla option with a price of $19.55, we actually have to multiply that price by 100 to get the option's actual value. So if we take the option's quoted price of $19.55 and we multiply that by 100, we get an option value of $1,955. That means that if I wanted to purchase this Tesla put option for a quoted price of $19.55, I would actually need $1,955 in my trading account to purchase this put option. In options trading, this is called the option contract multiplier, and in 99% of the options that you're going to encounter and be looking at, the option contract multiplier is going to be 100, which means the option can be converted into 100 shares of stock. And because of that, when you look at the option's price, you have to multiply it by 100 to get the option's actual dollar value. The second, and perhaps the most important concept that you need to understand after watching this video, is that a put option's value is directly tied to its strike price and the relationship between the strike price and where the current market price of the shares currently are. If I own a Tesla put option with a strike price of $350 and Tesla shares are currently trading at $300 per share, my $350 put option is going to be very valuable because the ability to sell shares of stock at $350 as opposed to the current share price of $300 is very valuable. More specifically, since I can sell shares of stock $50 above the current market price of the shares, this 350 put option is going to be worth at least $50. Now, as I described earlier, if the price of the put option is $50, I have to multiply that by 100 to get an option value of $5,000. We can make sense of this price by understanding that if the put option allows me to sell shares of stock $50 above the current share price of $300, and I can convert the option into 100 shares of stock, the ability to sell 100 shares of stock $50 above the current market price gives the option a value of $5,000, since a $50 gain times 100 shares gives me a gain of $5,000. Now what that means is if I sell shares of Tesla $50 above the current market price and I do it 100 times, that means I have a gain of $5,000. As a result, this put option has to be worth at least $5,000 in value, because if it were worth any less, then I would have a risk-free profit that I could make by doing certain transactions with this put option. When a stock price is below a put option strike price, the put option is said to have intrinsic value, and intrinsic value can be understood as the benefit associated with selling shares of stock above the current stock price. So in the case of owning a Tesla put option with a strike price of $350, if the stock price is at $300, then this put option has $50 of intrinsic value. In options trading, it is a law that options must be trading for at least their amount of intrinsic value. Otherwise, there is a risk-free profit to be made. If a put option strike price is below the current share price, the put option does not have any intrinsic value, because there's no value of selling shares below the current market price when a market participant can simply sell shares of stock at the current share price and be better off than they would be if they exercised the put option and sold the shares of stock at a lower stock price than where the shares are currently trading. Obviously, no one would ever choose to sell something for a lower price than is available to them. So therefore, if a put option strike price is below the current share price, the put option has no intrinsic value, and any value that that put option has is considered to be extrinsic value. But don't worry, I'm going to describe that in just a moment. Now that we've gotten some of the basics out of the way, how do put option buyers actually make money on their trades? Getting back to our Tesla example, if I own a Tesla put option with a strike price of $300 and the stock price is currently at $300, we know that that 350 put option will be trading for at least $50 in value, which in actual dollar terms is a $5,000 option. If Tesla shares decreased to $275, now the strike price of $350 is $75 above the current share price of $275, and therefore the 350 put option will be worth at least $75, and when we multiply that by the option contract multiplier of 100, we get an option value of $7,500. So if I were to purchase this put option in Tesla for $5,000 and the share price decreased by $25 to $275, that put option would be worth $7,500, at which point I could sell the put option, close the trade, and I would make $2,500 on the initial $5,000 invested into the option. When buying put options, the way you make money is to see a rapid decrease in the stock price before the option expires. More specifically, when you buy a put option, you want the stock price to decrease as much as possible and as quickly as possible, as that will result in the greatest price increase in the put option, which you can then sell at a later date and pocket the difference between your purchase price and sale price. How do put option buyers lose money? This is more important to understand because this is the more likely scenario that you're going to encounter when buying put options, because when you're buying options in general, you have multiple things working against you, and therefore you have a pretty high probability of losing money, at least on a day-to-day basis. Understanding that a put option's value increases as the stock price falls, it makes sense then that a put option's value will decrease as the stock price rises. That's because if you have a put option, such as the 350 put option in Tesla, and Tesla shares are currently at $300, that put option is going to be worth at least $50, because the ability to sell shares at $350 when the stock price is at $300 has to be worth at least $50 per share. But let's say Tesla shares increase to $340. now that 350 put option is much less valuable because now that share price of $340 is only $10 below the put option strike price of $350, which means that put option only has to be trading for $10 or $1,000 in value. If I purchase that put option for $50 or $5,000 in value and Tesla shares increase to $340 and that option price was only $10 or $1,000 in value, I would have a $4,000 loss for every put contract that I purchased. The most straightforward way a put option buyer can lose money is if the stock price increases, because if the stock price increases, that put option's value is going to decrease, because if the strike price is above the share price and the share price increases, that put option's ability to sell shares of stock above the current share price is now less valuable since the strike price is at a smaller premium to the current share price after an increase in those shares. But an increase in the stock price is only one way you can lose money when buying put options. The second way you can lose money when buying put options, and something that will always be working against you, is from the loss of extrinsic value as time passes. As I mentioned earlier, an options price consists of intrinsic value, but also extrinsic value, and as time passes, extrinsic value will come out of an option until only intrinsic value remains at expiration. For this reason, extrinsic value is sometimes referred to as time value, since if you look at options with lots of time until expiration, they will be trading with more extrinsic value compared to that same option with much less time until expiration. Let me go ahead and hop over to the tastyworks trading platform and look at some options and discuss exactly how much extrinsic value is existing on those options and illustrate to you how the options price will change as expiration approaches and as that option loses its extrinsic value. I just opened up tastyworks and right now I'm on the Tesla option page, and this is accessed by going to the trade tab right here on the left hand side. And we know I have Tesla options pulled up because I've entered Tesla into this search box up here, and once you do that, all of the information that you see on the platform will be relevant to Tesla. So this is the option chain for Tesla, so these are the different expiration cycles. And really quickly, I'm going to open up the January 2020 options just to demonstrate to you extrinsic value. The put options are going to be on the right-hand side, and I know that because it says puts on the right-hand side of the strike prices. So if I look at the option with a strike price of $350, and I go to the right of that, if I go to the right, that puts me in the put section, and if I look at the strike price of $350, this will be the 350 put option. As we can see, the 350 put that expires in 53 days is trading for about $27.50. And I know that means that this option is actually trading for a value of about $2,750. If I click on that, I can see that the maximum loss is $2,735, which demonstrates the fact that if this option is quoted at $27.40, the maximum loss potential is going to be 100 times that due to the option contract multiplier of 100. And if we take $27.40 times 100, we get a maximum loss potential of $2,740. So that means if I buy this put option for $27.40 and it expires worthless, I will lose $2,740 for every contract that I purchased. We can see over here it says EXT is minus $1,485. So this is telling me that there's $1,500 or about $1,500 of extrinsic value in this option. So since this option is trading for $27.40, if we look at the intrinsic value of the option, which is the difference between the strike price of $350 and the last price of Tesla, which is about $338, I get intrinsic value that is equal to about $12 on this particular option. So if we take $1,500 plus the intrinsic value of $1,200, I would say, then that gives us an option price of about $2,700. $1,200 of this option's value is intrinsic, which is coming from the difference between the strike price of $350 and the stock price of $337.60. So the ability to sell 100 shares of stock at $350 as opposed to $337.50 is $12.50. So that intrinsic value component is going to be about $12 for this particular option, and that means the remainder of its price is extrinsic value, And we can see right here on the bottom left-hand side, it says there is about $1,500 of extrinsic value in this option. And in terms of the options price, that means there's about $15 of extrinsic value in this particular option. So all that means is that if I bought this option for $27.40 and Tesla was right where it is in 53 days, so if Tesla was at $337.50 in 53 days, this option's price would only be intrinsic, since all of this extrinsic value is going to wither away as time passes. And that means if I bought this option for $27.40 and Tesla's right where it is in 53 days, I'm going to lose $1,500 just from the loss of extrinsic value as time passes. I can also illustrate time decay very quickly for you by just looking at the same option at varying amounts of time until expiration. So I'm going to go to the January 2022 options, which have almost 800 days to expiration. And if I look at the 340 put option, we can see that this option is trading for about $90. Now, if I change this column to EXT, I can actually show you the extrinsic value that exists in each of these options. So if we look at the 350 put option with 800 days to go, this option is trading with about $82 of extrinsic value. Now, if I go to the 350 put option with 53 days to go, we can see that this option has about $15 of extrinsic value. And if I go to December 2019 options with 25 days until expiration, I can see that the 350 put option with 25 days to expiration has $7.94 of extrinsic value. So if we look at the 350 put option across 3 different time periods, we can see that the longer time period gives me the most extrinsic value, and the shortest time period gives me the least amount of extrinsic value. So this is a quick way of describing the extrinsic value decay. So as an option approaches its expiration date, it will trade with less and less extrinsic value until it only consists of any intrinsic value that it has at expiration. Up next, we're going to look at some historical put option trade examples so you can see exactly how those trades performed and made or lost money based on changes in the stock price and as time was passing. In this example, a put option with a strike price of $77.50 and 74 days to expiration is purchased for $4.95. The maximum loss potential of this position is therefore $495, since a $4.95 option actually costs $495 per contract due to the option contract multiplier of 100. So if I buy an option for $495, the most I can lose is therefore $495, since if the option price goes to $0, I will have lost the entire $495 premium that I paid for that option. The break-even price of this position is $72.55, which is the strike price of $77.50 less the $4.95 cost of purchasing that option. The break-even price is $72.55 because if the stock price is exactly at $72.55 when this put option expires, the $77.50 put will be worth $4.95 because the put option will have $4.95 of intrinsic value at expiration, and as I mentioned earlier, an option will only have intrinsic value when it expires. Early on in this trade, we can see that the stock price falls quickly and the value of the $77.50 put option increases. With a quick decrease in the stock price right after purchasing the put option, the put's value increases to about $6.25. At a price of $6.25, a trader who purchased the put option for $4.95 would have an unrealized profit of $130 per put option. The trader could sell the put option for $6.25 to realize this $130 profit per put option, but of course there's no knowing that the stock price is about to increase, and for that reason, let's assume that the trader in this case stays in this trade and does not close the position. As we can see, the stock price teeters around the $77.50 price level over most of the remainder of the trade before rallying sharply before the put's expiration date. The put's price decreases steadily because as time passes without a decrease in the stock price, it becomes less likely that the put option will become significantly more valuable before it expires, as there's less time for a big stock price decrease as the option gets closer to its expiration date. At expiration, the stock price is above the put strike price of $77.50, and the put expires worthless because it has no intrinsic value, meaning there is no value in the put's ability to sell shares of stock for $77.50, since a trader could simply sell shares of stock at the higher market price of the shares without the use of the option. If a trader bought the put option for $4.95 and it expires worthless, they will realize a loss of $495 per put option that they purchased. This example is a great demonstration of the extrinsic value decay as time passes, as we saw a steady decrease in the options price as the stock price did not decrease and time was passing. Let's now look at a put option purchase that makes lots of money. In this example, a put option with a strike price of $300 and 63 days to expiration is purchased for $52.70, which gives the trade a break-even price of $247.30. The maximum loss potential of this position is $5,270 per put contract purchased. The put is so expensive in this example because the strike price is way above the current stock price, which means the put has lots of intrinsic value at the time of entering the trade. As we can see, the stock price decreases steadily over the entire duration of the trade and is well below the break-even price of $247.30 at the time of expiration. At expiration, the stock price is around $215, which means the 300 put option has $85 of intrinsic value because the 300 put has the ability to sell shares of stock $85 above the share price of $215. With an initial purchase price of $52.70, an increase in the put's value to $85 means the trader has a gain of $3,230 per put contract purchased, or a 61% return on the initial $5,270 cost of the option. This trade example demonstrates the attractiveness of purchasing put options as opposed to shorting 100 shares of stock. When shorting 100 shares of stock, you have theoretically unlimited loss potential since there's no limit to how much a stock's price can increase. When buying a put option, it doesn't matter if the stock price goes to 1,000 or 2,000 or whatever the number is going to be. If the stock price is above the put option strike price, the put option will expire worthless, which means when you buy a put option, you have limited loss potential, which compared to shorting shares of stock is much more attractive than having unlimited loss potential in theory. But remember that when you buy a put option, you need the stock price to decrease in your favor and in the time period that you've selected based on the number of days to expiration before your put option expires. Because of that, buying put options is a low probability trade, which means when you buy put options, there is a greater than 50% chance that you are going to lose money on that transaction because of the fact that you have to time the decrease in the stock price and you have to be correct about the magnitude of that stock price decrease as well. To show you what buying put options looks like on real brokerage software, I'm going to open up the tastyworks trading platform and I'm going to actually purchase a put option so you can see what it looks like to actually set up a put option purchase and execute that trade, therefore putting that position in your portfolio. And then I'm also going to show you how you can close that exact same position once you've purchased the put option. At this point, I'm going to show you exactly what it looks like to actually purchase a put option using the tastyworks brokerage platform. For this, I'm going to look at a different stock than Tesla, and for this I'm going to go to IWM, which is the Russell 2000 ETF. To purchase a put option, or to purchase any option for that matter, you have to click on the ask price. So the bid price is the highest price someone is willing to pay for an option, and the ask price is the lowest price someone is willing to accept for selling an option. And since I want to buy an option, I have to go to those who are willing to sell that option, which means I am going to be clicking on the ask price. So I'm going to go ahead and look at the 160 put option. This is just an example, and it's not a trade recommendation by any means, but I'm just going to go to this 160 put option, and as I can see, the quoted price is around $1.85, which I know this means the option cost is $185. So if I click on the ask price of $185 on the 160 put option, this sets up a trade to potentially trade this option. This is not executed yet. This is just setting it up so that I can review everything and look at all the details relevant to this particular trade. And then from there, I can decide whether or not I want to execute the trade. So as I said, this option is trading for $1.85. And if I look at the maximum loss down here, that says $185. Now that's just illustrating the option contract multiplier, and all that means is that if the option price is quoted at $1.85, I have to multiply that by 100 to get the option's actual cost on a per contract basis. Let's say I want to buy this option for $1.85. I can click this little lock with $1.85 selected, and this will make it so that this price does not change as this option price changes. So if I click review and send, this will just review everything with this order, and it says the estimated trade cost is $185, and that's because I'm buying an option for $1.85. Plus the commissions and estimated fees, I get a total trade cost of $186.14. So that's the amount of money I need in my account to actually purchase this option. So if I click send order, I'm anticipating that this order will be filled immediately because I'm trying to buy an option at the ask price. And whenever you're trading options, you will typically get filled immediately if you buy at the ask price or if you sell at the bid price. But now it's just changed, but let me see what happens if I try to buy this for $185. So I just got filled on the IWM 160 put that expires in 25 days, and I bought that option for a price of $1.85. I can go and look at this position in my portfolio by going to the positions tab, and if I open up IWM, we can see that I own one put contract that expires in December of 2019, and this has 25 days to expiration. The strike price is 160, and this P indicates that it is a put option. So the trade price is the price I purchased or entered the trade for, and this says minus 185, which means I paid $1.85 for this option. The mark or the current price is $1.85, and that gives me a P&L open of $0 since the option has not changed prices since I bought this position. So I'm going to go ahead and actually close this put option because I do not want to actually hold it, and I do that by clicking on it to highlight the contract. I right click, hit close position, and this will set up a sell order to sell this 160 put contract expiring in 25 days. And if I already own one contract, if I sell one contract, those two positions will offset, and I will basically have whatever profit or loss I have between the difference in my purchase price and sale price. So I'm going to go ahead and try to sell this for $1.84, and if I do that, click send order, I just got filled for $1.84, which means I lost $1 on this trade. I bought the option for $185 and I sold it for $184, therefore taking a $1 loss on that transaction. I was fully expecting to lose a small amount of money on this trade just to show you what it looks like to actually enter and exit a put option purchase. So hopefully this clears up the common misconception that when you buy an option or when you trade options in general, since they do have an expiration date, a lot of beginner traders think that you have to hold the position to expiration, but hopefully this demonstrates that when you trade options, just because an option has an expiration date doesn't mean you have to hold until the expiration date. You can close a position whenever you want, and all that you have to do is execute the opposite trade that you did when entering the position. So for buying a put option, to close that position, you just have to sell the same exact put option and with the same amount of contracts, and when you sell that option, you will secure the profit or loss that you have on that transaction at that particular moment and based on whatever your entry and exit prices were. At this point, we've talked a lot about buying put options as a trading strategy, so let's switch gears and talk about selling put options or shorting put options as a trading strategy. Essentially, when you short put options, you're taking the opposite stance as someone who buys a put option, and when you short a put option, meaning you sell it without owning it first, and you sell the option as an opening trade, your goal is to buy back the put option at a lower price in the future. As we know, a put option's price will decrease if the stock price increases or if the stock price does not decrease by too much as time passes. So when you short a put option, you are betting that the stock price is going to increase or at least remain above the put option strike price as time passes, as those two scenarios will result in a decrease in the option's price and therefore you'll be able to buy back the put option at a lower price in the future, and you will secure the profit that you have on the trade at that moment. Let's look at some historical trade examples so you can see exactly what I mean by this. In this example, a trader shorts a put option with a strike price of $150 and 37 days to expiration for $8.88. This means the trader's break-even price is the short put's strike price of $150 less the $8.88 premium received, which comes out to $141.12. If the stock price is above $141.12 at expiration, the 150 put will be worth less than the initial sale price of $8.88, which means the short put trader will profit. When selling options, you adopt a sell high, buy low mentality, which means you want the option price to decrease after shorting the option. A put option's price decreases when the stock price remains flat or increases over time, as the put option will steadily lose its extrinsic value and generate profits for a short put trader. In this example, the stock price increases steadily and the 150 put's value slowly decays. At expiration, the stock price is above the 150 put strike price, which means the put has no value at expiration since the option has no intrinsic value. If the trader held this position to expiration, they would make $888 per put option that they shorted, as they sold the put for $8.88, and the put expired with a value of $0, which is another way of saying the put expired worthless. As I mentioned earlier, selling put options is a high probability strategy, meaning that when you sell a put option, you have a greater than 50% probability of making money in theory. And that's because when you sell a put option, you have the extrinsic value decay in your favor, which means as time passes and as the extrinsic value comes out of that put option, that is going to benefit you as an option seller, because when you sell options, you want the option price to decrease, and one of the ways that happens is through the extrinsic value decay as time passes. The second way a put option's price will decrease is if the stock price increases, as put options across the board become less valuable as the stock price increases. Let's go ahead and look at a short put trade that ends in disastrous fashion so I can illustrate to you exactly how much risk is present when you do sell a put option. In this example, a put option with a strike price of $110 and 49 days to expiration is sold for $4.20. This gives the trade a break-even price of $105.80. The maximum profit potential in this case is $420 because the option was sold for $4.20, and the lowest value the option can reach is $0. Unfortunately, the stock price gapped significantly lower and was about $15 below the put strike price at expiration, and that means the put option was worth about $15 at expiration, since if the put option has $15 of intrinsic value at expiration, that means the put will be worth just about $15, since at expiration, no extrinsic value will exist in the option's price. With an initial sale price of $4.20, an increase in the put's value to $15 translates to a loss of $1,080 per put option sold, and the fact that the trade lost $1,080 but had a maximum profit potential of $420 demonstrates the riskiness of selling put options by themselves. It also explains why a trader will have to put up a significant amount of margin to initiate the trade. The loss in this particular example wasn't too bad, but it does illustrate that when you sell put options all by themselves or sell naked put options, the loss potential is going to be more than the profit potential on that particular trade. And because the profit potential is less than the amount you can lose, selling put options is a high probability strategy. Really quickly, I'm going to show you what it looks like to use real brokerage software and short a put option, meaning you're selling a put option as an opening trade, and that means that you are selling a put option that you do not already own. Really quickly, I'm going to show you exactly how you can sell a put option as an opening trade. Now, as we can see here on this trade page, there are no indicators that tell me I have any positions on, and that's because I do not have any positions on in IWM. So to sell an option, you're going to click on the bid price, since the bid price is the highest price someone is willing to pay for an option. So let's say I wanted to sell this 159 put option in IWM. Since the strike price is 159 and IWM is currently at 161.50, this option's price is 100% extrinsic, and I can verify that by looking at the price of around $1.51 and looking at the EXT column that I have opened up here, and the EXT column says $1.52. So this means that this option has $1.51 of extrinsic value, and that is the entire price of the option because this option's price is currently about $1.51. So to initiate a sell order, I'm going to click on the bid price for the 159 put, and this puts a red box around the contract, and on the right hand side it says S1, and this is indicating to me that I am looking at selling one of these 159 put options that expire in 25 days, and this put option is on IWM, which is the Russell 2000 ETF. So I'm going to try to sell this option for $1.50, and if I sell this option for $1.50, that means I will collect $150, and the best case scenario in this trade is that the option price goes to $0, at which point I will secure a profit of $150 for every contract that I sell. So I'm going to go ahead and actually decrease the price to $149 since the mid price, or the midpoint between the bid and ask, is actually $149. So I'm going to hit review and send, and this is saying the estimated trade cost is a $149 credit, and that means since I'm selling this option, I will collect the credit, and when I eventually buy back this option to close the trade, I will have to pay out an amount to close that option, and whatever the difference is between my credit and debit, that will be my P&L on this trade. So the estimated buying power effect, this is important to know because as I mentioned in this video, when you sell an option, you have significant loss potential because, for example, if IWM went to $0, then this option would have $159 of intrinsic value, and therefore this option would be worth $159, and if I multiply that by 100, that would give me a value of the option of just about $16,000. So I can see the maximum loss potential is just about $16,000, and that's because if IWM goes to 0 and the option price goes to $15,900 and I've collected $150 for it, my maximum loss potential will be $15,900 less the premium that I collected, which in this case is $149. Now, since the loss potential is so significant, I have to put up what is called a margin requirement. So the estimated buying power effect is stated to be just under $3,000, which means if I want to sell this put option without any protection against it, I need $3,000 in my account to initiate this trade. Now, I'm not going to be able to get filled at $149 because, as we can see here, the price has moved a little bit lower. So I'm going to have to adjust my price to $146. I'm going to go ahead and click review and send order. So I have not yet been filled, and that's because the ask price is $146 and my order price is $146. And if you try to sell an option at the ask price, typically you will not be able to get filled because you'll be able to get filled immediately at the bid price or somewhere in between the bid and the ask. But typically you will not be able to sell an option right at the ask price. So I'm going to go to positions. I'm going to right click on this working order. I'm going to hit replace. I'm going to decrease the price to $145, review and send order, and now I have been filled on this trade for $1.45. Now, as we can see here, there is a box around the bid price of the 159 put, and it says -1. Now, this means that I have an open position in this put option, and I have a short position as indicated by the negative number of contracts. So the -1 means I am short one of these 159 put options, which means I sold one of these put options as an opening trade, which means I am short this option. So I'm going to go to my positions tab, and I can see here it says -1 on the 159 put that expires in December 2019 with 25 days to expiration. So the trade price is what I entered the trade for, and that's $1.45, and the mark is $1.48, which gives me a P&L open of -$3. That's because since the option price increased by $3 from my entry price, I have a $3 loss. So if I go ahead and try to buy this option for $1.48, I will secure the $3 loss, and I'm going to go ahead and do just that. So to do that, I just click on this IWM option, right click, hit close position, and this is going to queue up an order to close this position. And I'm going to go ahead and lock this in at $149, review and send order. So I have just closed this position for $1.49, and since my initial sale price was $1.45, I took a $4 loss on that transaction. But as I did before, I was fully expecting to take a small loss on this position, because when you enter and exit an option position in just a few minutes, typically you're going to take a loss because you're going to lose the bid-ask spread. But in this case, the option price actually increased by a very small amount. So hopefully this was helpful in demonstrating to you how you can sell a put option without owning it first, or in other words, shorting a put option. And more importantly, how you can close that position at any time by simply buying back the put option that you initially sold. Instead of buying or selling puts all by themselves, traders often implement put spread strategies, and that means that you are trading a put spread as opposed to buying or selling a put all by themselves. I have complete videos that I've dedicated to buying put spreads and selling put spreads, which you can find in the links in the description. So if you're interested in learning about the put spread strategies, I would highly encourage that you watch those videos, because you will learn about how to mitigate some of the downsides that we've discussed in this video as they relate to buying and selling put options all by themselves. If you enjoyed this video, please give it a like and share it with somebody that you think would also benefit from the content that I've discussed within this video. I'd also love to hear from you, so please leave me a comment down below this video. I'm Chris from Project Option, and I will see you next time.